So the question we want to answer today is how to forecast the direction of the market, or at least increase the likelihood of getting a better idea of how to call the direction of the market. And I can already tell you what we will look at here today. This is, again, not a blueprint. It's not that you say, oh, great, I listened to this webinar now, and then I know how to get a better idea of where the market will likely go, up, down, depending on the market data, on the fundamental piece, which will be published. Let's have a look, for example, last week on Friday, non-farm payrolls. So it's one of the most anticipated news events of the month, in fact. So first Friday of the month, and many traders around the globe are looking here at the at this data set and hope to get a better idea of where the market will likely go, then move then. So what I will try to present to you is how I use my fundamental knowledge, and then use this fundamental knowledge, get an idea on what the bias of market participants is currently like, and then what this or that data release will likely cause in regards to action, and why certain levels will be sometimes are looked for from market participants and act as kind of a, let's call it, magnet, for example. So today's agenda. Oh, that was the trick. Just give it a click. Oh, cool. Okay, so today's agenda. First of all, we want to have a look here at technical analysis, give a brief introduction to this topic. So we won't dig into certain patterns or something, but just get an idea on what technical analysis is about. And then how to combine technical analysis and market data, and what are the benefits. This is the question we want to answer here. And then sure, the question is, in which markets is this approach the most effective? And also, can we predict the direction of the market? So I somehow answered already this last question. Still, I'd like to give you an example, a current example, in fact, and how to use, for example, these pieces we create. So some of you might have a look here at admiralmarkets.com and the traders block section there. And every Monday, as for example, today, there is a weekly article published. And what I cover here, so I write down my thoughts on this. What I covered here is 5 markets, or not 5 markets, but 5 currencies, respectively. 3 currencies it is, and then 1 index. This is the DAX, and then also gold, and give you an idea of what market participants look after. Some of you might have read this and thought, okay, great, yes, this guy somehow knows which market events will probably cause some volatility over the next week. But at the end, probably it's only a small fraction, which would probably have said, well, great, this is awesome, because now I have an idea for the bias, and based on that, I can draw some conclusions on which direction the market will go here. And the beautiful thing is that I wrote something on JPY, for example, last week already on Monday, and then last week we had the Fed on Wednesday, we had the BOJ on Thursday, and the beautiful thing is it worked out perfectly. And so we want to use this current example here to give an idea on the many texts I have here. So I try to bring in some pictures also. But before we start, first of all, this is me. So it's probably not that interesting, again, to go through all these details here. If you want to have more information on me, probably check out the recording of this webinar. Will be available, I think, somewhere tomorrow, or the chat box right now. Below the chat box in the YouTube channel from Admiral Markets, there you have a link on an interview I gave with Admiral, or I did with Admiral already 3-4 months ago, on my start in this business, and how I started trading the markets myself. What's probably the most interesting thing, and gives a very good idea of where Admiral Markets comes into play, is that I'm located in Berlin, in Germany. And Admiral Markets has, in fact, has several offices around the globe, but also one in Berlin, and is probably one of the most renowned and biggest FX and CFD brokers around the globe, with not just lots of licenses here, but also very, very competitive spreads, a very competitive offering in regards to trading. So to give this a more detail, and this is why it's probably interesting that I'm located in Germany. When we refer to Admiral Markets here, we usually talk about the so-called DAX expert. So there is not many brokers, if at all, to be honest, who can who offer something so competitive in regards to the DAX, especially. So in the let's call it the normal version, the standard model, there is a 0.8 point spread for the DAX, and that's it. In fact, my trading is in the so-called Admiral Prime offering, and there I'm working with a 0.2 point spread and pay the commission on top. And this is especially important, not just for me, but also for especially short-term traders, so scalpers who are looking for very competitive spreads and sometimes, yeah, look for only small moves in the market. In fact, one of the reasons you definitely should give Admiral a look, and not only is the DAX one of the most competitive offerings here, but also a very highly competitive offering when it comes to the FX market, for example. Here you see dollar JPY, as we want to have a look at. And the beautiful thing is, and this is also very important to many around the globe, is some of you are looking for customer support in their native language. At Admiral, you have a very good chance that you will reach or talk to someone in the service department here when it comes to questions around your account. Since Admiral has offices in over 20 countries around the globe, and so definitely worth a look. So let's get it started. Let's start with introduction to technical analysis. I shortened this up to TA, in fact, and so what we already might know is that technical analysis was formed out of the basic concept gleaned from the Dow theory, a theory about trading market movements that came from the early writings of Charles Dow. And the two basic assumptions of Dow theory that underlie, in fact, all technical analysis. In fact, I suppose if some technical analysts and purists especially are looking at this right now, they might say, hey, there was way more around Dow theory and which should be mentioned here. We want to focus on only the two main concepts which are of interest here. So first of all, the market price discounts every factor that may influence a security price. So everything you see in the chart has all information included. And market price movements are not purely random, but move in identifiable patterns that trends especially that repeat over time. Especially this is something which is not a big surprise, since what you see in a chart is the product of human beings, right? So we are all human beings. We are all driven by emotions, and we tend to behave in the same ways over and over again. Here, for example, we had several webinars in the past. I ran several, but I also know that Paul and Marcus also had several webinars on the mental side of trading. And I, for example, mentioned the so-called loss aversion. So that human being, retail traders especially, tend to let losing trades run while they cut winning trades short. And this is given through the fact that human beings are human beings and that they overweight losses, in fact. And which means that let's assume you have €1 you gain on a trade, and you make this euro. If you have a loss of €1, in fact, you need to make €2 to have the same positive feeling you connect with the loss of €1. So that sounds very difficult at first or a little irritating, but in fact, I think everyone can grasp this concept. So you overweight losses when it comes to them in regards to the monetary approach, which is one of the reasons, for example, why break-even stops are sometimes so difficult, because at the end of the day, you haven't lost. But if the market, let's say, moves, let's say, €100 in your direction and comes back, and you give back all these losses, these €100 feel like €200, in fact. And this is in regards to the loss, and which means nothing more than you probably breaking even on the trade, but it feels the break-even trade feels like a loss at the end of the day. And the reason for that is some classic human behavior called loss aversion. And these psychological aspects, in fact, are the reason then, if we look at it from a broader perspective, more general perspective here, which random patterns occur, but still patterns repeat over time, and due to the psychological aspects, or psychology driving retail traders, in fact. So now the question is benefits of combining technical analysis and economic data. So probably let's before we dig into this topic, let's give a little broader introduction to this. So why do I like to combine, especially technical analysis and economic data, or fundamental analysis? Some of you might refer to this as fundamental analysis. In my case, in fact, it's everything the same. It's economic data related. It's market data, economic data, fundamental analysis, all the same. If I talk about this, even though it also includes lots of more information than only just the data set, which is published like the non-farm payrolls last week. And why do I like to combine these two, especially respectively? Why I also like to give more look, for example, at something we refer to as sentiment. This is the bias, which is currently within the market and driving the market in one or the other direction. For example, let's look at the current bias. So we have November 2013, and all what market participants currently look like is, or look after is, what will be the next step from this or that central bank. So will there be more or less dovish in their statement, especially now with these recession fears rising, for example, and when looking at the trade war between the US and China. Probably they will find a deal now. So right now, at least there is this partial deal everyone is talking about. But still, there's fears that this trade war, rather sooner than later, will switch over to the global economy and affect global economies. Then from China and the US, especially China, switching over or seeing some spillover effects to emerging markets, for example, and all this. So this is right now what market's driving, which means nothing more than, let's put it simple. I mean, if everyone is expecting dovish approach from a central bank, like many did, for example, from the Japanese central bank, the BOJ last week, and they don't deliver. So yes, they somehow switched their forward guidance, okay, but still, it's not that they came out extremely dovish in their statement. So with a very, very loose monetary policy approach here, or a path, formulating a path which they plan to follow, and market participants priced in a dovishness, a certain level of dovishness, and it's not delivered, well, then the moves in the nearer past will be naturally reversed, because people anticipating a dovishness which is not given or which is not delivered. So if you sold JPY, you have to buy them back right now because you speculate, or you're caught on the wrong foot. Let's put it that way. So, and what I like to do is here, I like to look at the chart and see certain technical level which are of higher importance, so resistance zones, respectively support zones, especially whether we are in an uptrend or in downtrend, higher highs, higher lows, lower lows, lower highs, for example. So if there is some kind of sequence, and then I try to look at what's the current bias in the market. So I look at sentiment data, especially, for example, at the commitment of traders report. Something I don't want to dig into today. The reason for that is I don't want to cause lots of irritation, let's say. So what do I mean by that? Well, we'll look at a chart in a few minutes, which is dollar JPY. And when looking at sentiment, and for example, here at the so-called big speculators, which are covered with the commitment of traders report. Webinar, by the way, within this Trading Spotlight series, which was run by, if I'm not mistaken, Paul, I think. He gave an idea on commitment of traders report here and how to use it in your trading. The problem is when looking at the JPY here in this commitment of traders report, you look at JPY USD and you have to think, like as if you were looking in a mirror. So we are not looking at dollar JPY, but JPY USD, and so you have to think completely from a different perspective. You look at the same chart, and at the end of the day, no, not really. And to not cause that much irritation here, I just skipped this part. But what I want to use with this is then I want to know where's the market currently. So what are they expecting? If, for example, market participants are betting heavily on a central bank, for example, to come out very dovish in their statement or with their upcoming monetary policy decision, well, usually they will say, okay, this means they will likely cut rates, respectively try to not just cut rates, but drive them lower, for example, by increasing their current asset purchases, so-called QE program. And what we know is yields usually are kind of a measurement how attractive a currency is, which means the higher the yield, the more attractive a currency is usually. That means nothing more than if someone like the BOJ is driving yields lower, naturally you should expect JPY then to be sold beforehand, because market participants anticipate that there will be some kind of weakness in the future to be expected, since the central bank will or plans not only to cut right now at the meeting, but also to cut in the future then, and drive lower the attractiveness of the respective currency. So, and this is something which you should see then. So if all market participants, or many, are already expecting this step, and you can see in such data, which is freely available in the internet, for example, or which is then also delivered from the CFTC, and you see already that they are aggressively short, that means nothing more than most of this step is already priced in, which means nothing more. If they deliver as expected, then you get to see something like sell the rumors, or buy the rumors, sell the facts, or sell the rumors, buy the facts, depends on the direction. And this is where these quotes then in trading come from. And this is why I like to look at all these three levels here. For example, technical analyzed levels then could show you regions where you say, hey, cool, if I have a high here and we're trading slightly below that, it wouldn't come as a surprise to see an initial spike and then selling price action happening into this event. In fact, something we saw last week in dollar JPY after the Fed delivered as expected their rate cut. So this is just to give you an idea, and we can already see, okay, there's obviously no blueprint, and there's a lot of feeling you have to have for the market, which you have to develop over time. But if you have this feeling, and if you know what's driving the markets, it can be really, yeah, it's not only just fascinating, but it can also be very, very interesting from a money-wise or profitability perspective, because you can increase the likelihood of not being caught on the wrong foot, but being on the right side of the trade, and really anticipate probably also bigger moves if certain technical levels are then triggered and the market starts to move strongly in direction of the ongoing trend, respectively probably reverse from here. And you see a fake out. Okay, so let's have a look here then. So the benefits of combining TA, technical analysis, and economic data, first of all, it's that you understand what's currently driving the market and which events will cause volatility. Put this simple. I had once a client who came to me and said, Jens, I'm trading actively Euro USD. Okay, this is not such a big surprise, because Euro USD is probably one of the most traded currency pairs in the world. It's the most liquid, most traded currency pair in the world. Okay, said, okay, great. And what's the question? Yeah, today at, I think it was something like 5:30 p.m. German time or something, there will be a news release. It's Brazilian retail sales. Do you think that this will cause volatility in Euro USD? Simple question. Simple answer, no. Why? Well, because why should Euro USD be affected by Brazilian retail sales data or GDP data, whatever? It does not affect, it's not driving the market. What's currently driving the market is something like monetary policy decision. But also here, it's not necessarily sad that an ECB rate decision will cause some kind of volatility in the euro. Like last time when we knew that it will be the last press conference with Mario Draghi, it was on the 24th, 25th, so last, no, 1.5 weeks ago. So not last Thursday, but the Thursday before. And it was the last press conference with Mario Draghi. And no one should expect big monetary policy announcements being made there. And this is exactly what happened. We didn't see big moves in one or the other direction. And when we saw moves happening then it was most likely due to other circumstances or other trigger events, like monetary policy announcements, speculations arising around the Fed, which then published their rate decision or statement last week on Wednesday, or some kind of economic data coming from the US. But what you can clearly say is, if you follow the price action in a chart and you see some news events being released and then triggering some kind of volatility, you already get a grasp of what's right now driving the market. And then based on that, for example, last week, I was in the position to say, I don't think that the NFPs will cause huge volatility, but what I think is more interest next week or also the days to come, and this means, for example, tomorrow with the non-ISM manufacturing, it's currently ISM data, respectively purchasing manager indices, which are published. So PMIs, which are giving an indication of what to expect in the near future in regards to the optimism, pessimism around the global growth and the respective economy for which they are published, especially the US, for example. So this is what you get with time when looking at the price action. So it's not, I already tried to give you an idea right now, what's right now driving the markets, but this is already showing that you need to follow the action very closely in the markets and have to have a look at the economic docket and then also see, okay, does this cause volatility? You might follow economic calendar on the website. For example, upmarkets.com offers a very, very great economic calendar due to the fact that you can really filter all the news events relevant for your currency pair, for example. And you might someday see that there is balance of trade being published for the US, and you might say, hey, balance of trade, well, it's a high impact event, so this should trigger some kind of volatility. It probably does right now when it comes to China due to the trade war, but it's not a big topic when it comes to the US. It might have been in the past, it might be somewhere in the future, but this is not necessarily a market driver. So it could be that you look at the economic calendar and say, okay, this is a high volatility event, it's triggered, or it's shown here as high impact, but it's not necessarily said that this is the reason. It's from a pure fundamental perspective, a very important data release. Still, when it comes to the current price action, you have to closely watch and monitor the reaction of this high impact event on the market. And if it is shown as high impact event but doesn't trigger any volatility, just make a short note to yourself and say, okay, this is currently obviously not what markets are interested in, but they're looking at something else, something different. So then, what we also have to do, and there's where technical analysis comes into play, we have to identify potential action levels and see if the market is probably at level extended, for example. Something we want to look at in a practical example on dollar JPY, where you can perfectly see this. There was a high action region, potential region around 109, and we saw a short spike above that level, and then we're aggressively sold into the Fed decision itself last week on Wednesday already, and then the market started to accelerate aggressively downside when the BOJ didn't deliver as expected. The action level here was 109, and thanks to basic technical analysis knowledge, in fact, so you don't need to dig really deep into this topic. In fact, it's easy to say, okay, this is the pre-weekly high, pre-weekly low or something. You have a sequence of high highs and high lows. Here was a former high, former low, whatever. It's sometimes very easy. It's a basic reading of the chart, which can already give you a very good idea of what markets are currently looking at and which levels are of interest for the market then. And then what we do is, once the data set is published, the market will go very likely to the region where it expects to find the highest level of liquidity, gets the highest level of action. So what do I mean by that? Very interesting. So markets tend to be in markets you find supply and you find demand, and they are matched. Right? And the region where the market will go here is where it finds the highest level of suppliers and those who demand a certain good, and where the highest I'm sorry, I'm missing the word. It's in German, it's Umsatz. I'm sorry. It's like I just don't have the word for this, where the highest, turnover, let's say turnover, probably this is getting the job done. So where the highest turnover is generated. So, and this is something you sometimes might look at in a chart, and then you say, oh, look at this, they are already stopping, or again, they are stopping they are stop fishing again. So the market's spiking higher to a certain level, everyone can see, and the market spikes higher and is then aggressively sold back, or spikes lower and then is aggressively bought higher again. And the reason for that is not that everyone is looking for the stops who can be triggered there. I mean, if you expect there the highest demand and the highest supply to generate the highest turnover, well, naturally the market will go there, because this is what the market is there for. So it's not to play a game with you or to stop you out of a trade or something, but it's naturally what you should expect from a market to do. This is a sign of a market itself. This is the definition of a market, in fact. But we can use this information, especially if we do not have a position here, or also if we have one. This is something which was also described from someone like Paul Tudor Jones in a very, very great way in the book Market Wizards from Jack Schwager. So that book was from the 1980s, early 1990s, and there he talked about how such regions are identified by market participants, and how he, as one who was already trading big size in this market, who had to sell, to wait the market to push it in this direction, to sell, for example, if he was long in a certain market, to sell into this region then, because he could expect there that enough, in this case, when he supplied this or that equity, FX, commodity, whatever, that there was enough demand meeting his supply he was giving in the market for generating a price for him which is not causing slippage and has, in this case then, negative impacts on your performance, for example. And so it's very, very important, obviously, to understand what technical analysis is good for. For example, especially to understand that technical analysis delivers a good idea of where to expect these regions of high turnover, where supply and demands meet and the highest turnover is generated, to understand where these regions are, in fact. And then by combining information from economic release with market expectation, as demonstrated by the technical picture, then we can decide whether it's only a fake move, stop fishing move, or if the market has a chance to sustainably break through, thereby making informed trading decisions. Okay, so before we come here to the next slide, I'd like to go here now to the chart in dollar JPY. Okay, so what we want to look at is, let me just do the following. Let me include here rectangle. Yeah, why not? I mean, it doesn't matter. So we want to look here at this. This is what we want to look at. So you can see here, this is today's candle. It's the 4th of November. We look at the price action from here, the 30th of November, and then what happened there. Now, last week on Thursday, respectively on Friday, on the 1st, with the non-farm payrolls being published. So what happened here? The 30th was a very important news release. It was the Fed rate decision. Unfortunately, I don't have a chart to show you this, but I have a text I prepared the week before in this weekly piece. And now we go down to the 50-minute chart. And what I want to do is, well, probably this takes now a little. No, perfect. So look at this. Look at this price action here. Okay, what you see is, you see this big candle. It was at 2030. This is German time. So which no, I'm sorry. This is Cypriotic time. I think it's EET also. It's Estonian time. It's 7:30 German and 6:30 London in this case. And you see the spike higher. That was not when the news event itself was released and that the Fed will cut rates, but here there were some comments released from Jay Powell, in fact. Okay, and then we see the spike higher, and then we start to drift lower, and we take on momentum. And overnight, then, especially here, with the European markets coming into play, the market started to accelerate aggressively lower, and yeah, traded as low as 107.80, 108 around, if I'm not mistaken. Yeah. So what happened here? So therefore, let's now go over to, let me just see, do I have it here? Yes. Let's have a look at the traders block section. You find it on admiralmarkets.com, and then here on analytics and traders block. If you click on this, you can now find the current piece, which is this one. But we want to have a look at the piece from last week. So last week on Monday, that was before the Fed stated that they will cut rates, respectively the BOJ came into play. So, and what you can see here is, I say, while a Fed rate cut of 25 basis points is nearly completely priced in. In fact, if we scroll a little higher, I think I have also a likelihood here. There's a likelihood of over 90%. So shortly before the Fed event itself, it was 100%. So market expected by nearly 100% that the Fed will cut rates by 25%. So the rate cut itself will definitely not cause any volatility because the Fed rate cut is already priced in here. So, but what's currently, or at least last week on Monday, what was interesting was more what will be the rhetoric in regards to a rate decision in December, and also around this current liquidity providing program, the so-called non-QE, to make sure that these liquidity shortage in the repo market is overcome here. They refer to it as non-QE, even though shooting or expanding aggressively the Fed balance sheet right now. But we want to dig too deep into these details here. But this was what is really of interest for markets right here. And not only that, so this is one of the reasons why the cut itself will most likely not affect, then in this case, the dollar, respectively dollar JPY. But what's of more interest is, again, what will come over this. So will there be any announcement which will make it likelier that the Fed will cut rates? What does it mean, make it likelier to cut rates? It's fantastic. This tool here, it's the so-called Fed Watch tool. It's a freely available tool. Everyone has access to this. You just need to Google Fed Watch tool. I will share the link, not just below the YouTube video, but I will also share it now in the chat box. Everyone can see this and see the likelihood of what will be the next step of the Fed here in this case. So right now, October is already out, but now you can see what does the market expect for December. So in 6 weeks right now, there's a likelihood of over 90% that the Fed won't do anything, which means leaving rates unchanged in this case. So when looking at this, you already have a good idea of, okay, then the market is obviously expecting such a rate cut, which will likely not affect dollar JPY on the downside. So it needs to be something in the rhetoric which is delivered, respectively something we're talking about currency pairs, which means also another currency, in this case the JPY then, might have triggered. This is something you can also see here, where I said, if in addition to such a dovish Fed rhetoric, it will be of interest what the BOJ delivers, especially after recent turbulences in bond markets in Japan. So alone for that, I think it's worth to read these pieces here to get an idea. So this is a likely sign I'm writing here that traders are finally paying heed to Kuroda's recent comments warning against excessive falls in super long yields and leaving us with expectations that the BOJ is to deliver a more dovish stance than currently expected. So that's what was expected. And then next week, again, the Fed delivered anything or didn't deliver anything really new, but the BOJ did. The BOJ here tweaked her forward guidance and to some extent delivered at least something dovish to not disappoint the expectations of market participants, but it also communicated that it felt that the Japanese economy was strong enough without the need of direct additional easing in this case. So they tried to somehow satisfy the expectation of market participants, but they didn't deliver it. What was the result? That was on Thursday. What was the result? Well, market participants expected a dovish approach from the ECB. They didn't deliver it. As a result, JPY was aggressively bought that day. and the dollar was at least stable to some extent, which means nothing more that dollar JPY will likely go lower. What's of higher interest is, in fact, now let's zoom into this chart. What do we see here? We see that the market is attacking this region of former highs here again. So pushing towards this region, as market participants can clearly see that this is a quite interesting region, must be, because you can spot it without even putting a line into the chart. You just look at the chart and see, okay, well, this is probably a region which is of interest for market participants, which means nothing more than here there will be a high level of action. So there will be demand and supply, there will be buyers and sellers. And what you can then say is that the market will likely push into that region. But since there was not enough, let's call hawkishness or restrictive monetary policy approach delivered from the Fed, the follow through here is unlikely to happen. So what you see instead is the market pushing higher and then being sold into this news event. And the further downside was accelerated by was accelerated by the not dovishness, let's call it, from the BOJ in this case. Okay, so this is an example of how these points we just went through here in the slide before, how they can find how you can use them in the real trading world, in fact. So now the question, where does the combination of technical and economic data works best? In fact, it's I created a chart. I will make it a little faster here. So you can build it in a way where you say liquidity and broadness and deepness of markets is the lowest, most likely, in indices, and then slightly above that probably in commodities. Then you have precious metals like gold, and then ahead of this, probably even a little higher in FX, not just even a little, but significantly higher of FX. So deep and broad starts to go from indices, commodities, over precious metals to FX and bonds, from here to there, which means nothing more. What I just delivered, these fundamental aspects, they play out in FX and also bonds here more heavily, let's say, than they do in precious metals, and they do the least in indices and commodities. So I expect a move which is fulfilling what I was thinking about here. I expect a move to be more sustainable and more dynamic, and also very how can we say that? To be of higher importance. The more liquid, the broader and the deeper the market is. That means I look especially and in first place at FX markets here, at bonds, and then I work my way lower to the lower time frames, especially to the indices. Then in this case, when looking at the DAX, for example. Okay, so now the question: can we predict the direction of the market? No, we can't, but still a solid understanding here of technical analysis and fundamental analysis here. So market data, again, economic data, however you call this, and combining the two can be very, very helpful for predicting market movements, especially when it comes to such sell by the rumor, sell the facts moves, for example. As a rule of thumb, we can say the more obvious a move is, the likelier you are to see a fake out here, in fact. That said, it's better to go with the flow instead of trying to predict the direction of the market. So to give a simpler example here, when my father, for example, came to me something like 7-8 years ago and said, everyone is talking about gold, what do you think about gold? I said, well, you should sell all your gold right now, because now you know it, and since you are not that deep into the matter, and you're talking about gold right now to me, means that most likely the party's over. And it was, I think, close to 1,900. So from there, a market nearly was cut in half and never made it back to these levels, even though right now I'm very, very positive for gold. That's also something I'd like to say. But this is a good rule of thumb already. And the more likely a move is to happen, and the more likely you think that now the markets will explode on the upside, the complete opposite is likely to happen, in fact. Same is true for Bitcoin, for example. My wife came to me, that was at the end of June. We were trading around 13,000 USD, if I'm not mistaken. And she was asking me for her mother. So my mother-in-law in this case, and then asking, what do you think about Bitcoin? And then she smiled and said, wait a second. I tried to answer the question myself. You once said to me that if I start, or my mother or whoever starts to talk about this, I should sell it. Is it right? Yes, I said, exactly. No, you should go short. And from there, we went like, I don't know, to 7,000 or something. So it's it sounds a little rude, but this is exactly here what sentiment extremes are about. And this is the same, which is true for markets. The more likely you're expected, where the higher the likelihood of a rate cut to happen, the more likely it will not affect the market in the way natural fundamental analysis should be expected. The only reason for the respective rate or currency to go lower is mainly due to the fact that on top of that, there's more dovishness delivered with, for example, QE program extended or something like that. So let's sum all this up. The basic assumption of technical analysis is that market price discounts every factor that may influence a security's price, and that market price movements move in identifiable patterns and trends that repeat over time due to human nature. By knowing the current market mode, so the BS in the market, the sentiment, we get an idea of what data potentially moves the market, and thanks to our TA, so technical analysis understanding, especially the basic knowledge, in fact, which is, in my opinion, enough, knowing where support resistance can be found, we can then also identify potential action levels. And yeah, the combination of TA and FA, so technical analysis and fundamental analysis, or market data, or however you call this, works the best in broad and deep markets, especially in FX and in bonds. And yeah, while with a good understanding of both research methods, we can come close to predicting the direction of the markets. Nevertheless, we should still try to go with the flow. So if we have a certain idea and based on our research, that move on the upside makes sense, and the market is completely moving in the opposite direction, it does make sense to say, but I researched the market this or that way, and because of this and that, it makes sense. If the market goes down, you should go down or at least stay out, because else, or it perfectly illustrates. If this happens to me, I see, I don't understand what's right now happening in the market. I don't understand it. I'm out. I'm not in. I wait for a clearer picture to develop and to be my rules and my setup to be triggered, and then I enter the market again. Yeah, so now don't forget to join us next time at the same time on Wednesday. It's then Marcus' slot here. He will talk to you on how to trade Forex and CFDs with limited funds, so trading with small accounts, why it's wise not to risk too much in the early stages of trading, the benefits of limiting the amount you deposit in your trading account, how much money do you really need to start trading, in fact, and also strategies for trading with low account balances. And when 2 p.m., same time as today, 2 p.m. London on the 6th of November, Wednesday, where check the inbox of your email account for your webinar link. And if you watch this on YouTube, feel free to click the link right here in the description. And by the way, YouTube, if you like what you just saw, please give us a thumb up. And if you have any questions, feel free to ask these questions in the YouTube video below, respectively in our Traders Yard community. I also share the link in the chat box. For more analysis education, the Traders blog I was just referring to, admiralmarkets.com. And here are the contact details. And this is the risk disclaimer. And that's it from my end. Thank you for your patience at the end, especially. And I wish you all the best. Happy trading. What's your stops? And talk to you then again next week, again on Monday, in fact, on the 11th of November. And that's it from my end. So see you. Talk to you soon. Bye-bye.